Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, thanks for joining us today. Today we're going to be talking about some of the banks, and we're going to split them into Bank of America, Citigroup, and Wells Fargo. So we'll just kick it off with Bank of America today. Bank of America, clearly the best quarter in my opinion so far. Goldman Sachs still has yet to report, but Bank of America really beat on every possible metric. So they beat on efficiency, they beat on loan growth. They had really solid loan growth actually, and they had good trading revenue as well. If there's one weak spot that Bank of America had, it's the advisory fees on M&A, and that's just really dependent on which deals they won this quarter. And overall, they've been doing pretty well in the underwriting, so I don't think the M&A weakness is any indictment necessarily on that part of the business. It's just a timing issue with the rest of the M&A activity. So if we just run through the numbers really quickly, the EPS was 64 cents. Street was looking for 57 cents. Overall revenue was $22.58 billion. Street was looking for $22 billion. Credit losses were significantly lower than expected. ROA improved on a year-over-year basis, although it was down 4 basis points sequentially. And interestingly, they were actually beat expectations on their credit, on the amount of liquidity and buffer that they had. They had a CET1 ratio of 11.5%. Street was looking for 11.3%. Now, it's important to remember that's still the low on the street. Among the banks, among the big banks, Citigroup is still about the low. Bank of America is still the lowest. Having said that, they're still pouring a lot of money into share buybacks this year. They should buy back about 5%, 7% of the shares outstanding. And the ratio of buybacks to dividends is the highest among the big banks, with the exception of Goldman Sachs. So this means that Bank of America thinks its stock is cheap, and they're also allocating more towards share buybacks than to dividends. Interestingly, on the operational front, they're again emphasizing digital. Last quarter, we talked about how my prediction was that Bank of America is going to be called a digital company not too long from now. They have that digital assistant called Erica, which is obviously the last 6 letters of America, Bank of America. And that is seeing some adoption. They're also seeing some good usage out of the mobile and other digital platforms. So Bank of America is making a big push on that. And that's one reason the consumer efficiency ratio has declined so much. The consumer efficiency ratio is now 48%, and they want to take that down even further. And they're going to continue to spend $75 million a quarter on these digital initiatives to further that. So it's good news there. Also helping on the operations front is that they're seeing historically low attrition rates, which is very good news because you don't want to have to train someone new. It's cheaper to keep someone who works there happy and continuing to work there. So that's good news on the attrition front as well. And in stark contrast, I would add to a company like Wells Fargo. And then also on the actual effectiveness front, they grew loans 5%, which actually beat Citigroup, which was up 4%. I think JP Morgan was up 4% as well. So really good loan growth. Then it's broad-based too. So while some of the other companies were seeing growth on the consumer and maybe some weakness or some just a lack of real robust underlying growth on the commercial side, Bank of America is actually seeing some good growth out of the commercial side, in line with what they're seeing on the consumer side. The credit cards are doing well also. Interestingly, they're continuing to increase deposits, although the deposit rate actually increased 7 basis points this last quarter. That was in context of a 25 basis point increase in the Fed funds rate, which means you're at a deposit beta of about 0.28. This is not materially different in my view from the 21.21 deposit beta that they had over the last couple of years. So what does this all mean? It means that Bank of America is able to effectively grow its margin through efficiency using the digital platform, and they also have robust exposure to a steepening of the front end of the yield curve. 70% of their interest rate exposure comes from the steepening of the front end. If there's a parallel shift, 100 basis point parallel shift, they would see their net interest income rise by $2.8 billion. But 70% of that is captured just from the front end alone. And that's what the Fed is governing. So that's really key. Because if you're exposed to the long end hasn't done nearly as much as the short end. So keep an eye out for that. And Bank of America is performing well there. If we do get that 100 basis point, that $2.8 billion does translate to about 22 cents a share with the current shares outstanding. But bear in mind that share count is going to continue to decrease. Like all the other banks, they're doing well with equity trading. But in terms of the fixed income, currencies, commodities, that has been relatively weak. Yes, they are up 2% year over year, which was certainly better than like what we saw of Citigroup, which disappointed on that metric. But that's just been characteristic of banks broadly this reporting season. So equities trading still fairly robust, fixed income not so much, but overall, Bank of America seems to be in great shape. They're growing deposits, they're growing loans, and in many cases, they're doing that faster than the rest of the industry. Question is, now how much longer can this continue? In my opinion, they're operating roughly about as well as they can. I've been wrong about that in the past, but I don't see where they're going to see that acceleration on an idiosyncratic basis. If the whole industry improves, then Bank of America should perform well as well. But as long as the industry is in a steady state or growing relatively slowly between 2 and 4%, then I don't know where Bank of America is going to have that outsized growth. They already trade at about 1.7, 1.8 times tangible book value, which is significantly higher than a company, say, like Citigroup. And they're performing really at the top of their game, which I'm not prepared to give Bank of America credit for yet because it's been a short time span. I think when you look at Bank of America versus JP Morgan's proven it over a longer period of time. Bank of America can get there, but they're going to continue to have to show it. So those are my thoughts on Bank of America. Check back for the other videos.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.